Hello and welcome to Street Signs. I'm Sonia Shenoy and with me is Udayan Mukherjee. Things have been good for the markets. In fact, sitting at record highs for the Sensex and the Nifty. The Nifty is holding at that 8550 odd level. So in the next half an hour, we'll get you some expert opinion to tell you how to approach the year end and of course the start of the new year. Udayan, hi. Welcome to the show. It's been great going for our markets, but it's also been great going for some of the other markets like China, etc. Now are you starting to get a bit worried about the Chinese outperformance, or do you think that India will continue to attract the flows that it has had in the last 1 year?
Well, India's had quite a good run, Sonia, already, but you're right in pointing out that some of our competing markets are beginning to sparkle with their recent outperformance. So I'm not suggesting for a moment that all the money goes out of India from FIIs and goes into China, but in the relative game in which India was doing so well, there's another player or another head which has popped up. So we need to be cognizant of that. Otherwise, we've had a great run to the year. December sometimes attracts some profit-taking from global funds who are sitting on tidy profits for the year. So you could see the market maybe flattening out a little bit and maybe not ending the year on such a strong note. But that may just be end of the year profit-taking and a little bit of relative adjustment because of China's emergence as a relative outperformer in recent weeks. I think the more interesting thing, Sonia, is now to ask what happens in the January-Feb period. Are we going to start the year on a very strong note going into the union budget, or will we see some turbulence between now and the union budget? We've all spoken about targets of ranging from 9,000 to 10,000 between now and then. So let's see what the journey is like. But for now, I wouldn't question the trend. I think some time-wise consolidation might just be in place as people rotate their portfolios around and try and preserve some of their NAVs going into the end of the year.
Okay, so since this is still very much a bull market, Udayan, give us two strategies, one for a long-term investor and the other for a trader.
You know, trading strategies are more difficult, Sonia, because you just back the trend, and that every trader who tracks technicals will tell you that's worked beautifully like a charm over the last many months. And anybody who's betted against the trend in any significant way has probably come out on the wrong side of the trade. So I think the best way to trade is to probably trade with deeper stop losses because the trend is strong, but pullbacks can be equally sharp. So you can suddenly get knocked back 150, 200 points, but that is not the end of the trend. It's merely a sharp pullback after which the market goes on to form a new top. That has been in place for the trader for the last many months that one can remember. And you stay with that and don't have very tight stop losses because you'll probably get jerked out of a long trade and then the market will probably prove you wrong. For longer-term investors, this remains a great market to be buying on every dip. I know that everybody is bullish at this point in time. Whoever you ask is talking about much loftier targets. That usually is not a great sign. But at the start of such a multi-year cycle, which it is looking like, I think it's reasonable to expect more people to be bullish than bearish. So at some point between now and the budget, I hope not after the budget because so much is riding on it, you will probably get another jerk or two down. But for longer term investors, you would need to use those jerk downs to probably add to your portfolios and spread out some of your mid-cap portfolios a little bit. They have run up quite a bit. They're vulnerable to pullbacks, but I think you would still do well to accumulate on dips for medium-term investors.
All right, I guess there are not too many bearish triggers at this point, so perhaps that leaves only a bullish bias in the market. But let's pose that question to Nirmal Jain of IIFL. He joins in now into this discussion. Hi Nirmal, thanks for joining in on Street Signs. It's been a great run for the markets, and you know, for the last couple of months, experts have been anticipating at least a minor correction, but even that has not come through. What are you expecting to see in the next couple of months as we head into the budget?
Yeah, I think, see, there are two key points to note here. One is everybody's talking about FIs and foreign money leading the rally in the market. And people even see the headlines that FI flows have been highest in this year. But the reality is that the flow in equities have been just about $16 billion till date. And of course, the flow in FI flows in debt have been significantly higher. But equity flows are nowhere near the peak they had in the last few years. So the market has been running a lot with local money as well, and mutual funds have been contributor. But to the best of my understanding, even insurance companies like LIC in the year to date have been net sellers. So, many times markets move up with sentiment despite the fact that the new money coming in may not be as big a driver as people think. And coming to going ahead, of course, market has run up, so is jittery at high altitude, and there are traders, they all kind of players in the market. And whenever markets seem to be correcting or there's a reason to correct, it can be sharp corrections because it's run up at that pace. Having said this, if you look at the market from 3 to 5 year perspective, then I think there's a long way to go. There's a lot of steam left. Markets are now at around 18.8 multiples of next year's earnings. But the key thing here to note is that next year, I think more or less everybody agrees that our economic growth will accelerate. It will accelerate not only because of the reforms by Modi government, but more importantly, we've been very fortunate that crude oil prices have fallen the way they've fallen very sharply in the last few months. That benefits India a lot. And whatever we hear from SAIL and sheikhs of Dubai, it looks like that prices will remain at these levels for quite some time, or at least in the foreseeable future. So that augurs very well for macroeconomic trends in India. And along with that, I think government is moving in the right direction, and a lot of reforms are now taking place. They increase excise duty on petrol to cut deficit. So I think government is very conscious of fiscal deficit, inflation, as well as growth, and also the thrust on infra. All these things will see economic growth accelerating, and then whatever I have seen in this market, you'll see earnings upgrade next year, and that will drive the market. Then continue the rally. Having said that, I am not an expert on the technical trends, and there can be intermittent corrections. So if you look at the market for 3 to 5 year perspective, still I think it's a good buy, and one should invest in the market with medium to long term perspective.
Hi Nirmal, what's your sense of how to play the pre-budget period this time around? I mean, very soon we'll be done with this year, and January onwards people start talking about this budget being such an important document. Are you apprehensive at all that because of the kind of fiscal numbers which are coming in, there is room for disappointment in this budget? Or do you think the Jan-Feb period will be a strong pre-budget move up this time?
I think markets undercurrent will remain strong, Udayan, because budget is likely to be good. From the finance minister's point of view, this is the first full budget that he's presenting, and all the trends are in his favor because the crude oil down by $30 to $40 per barrel. That basically augurs very well. Even when you do revenue forecast for next year, you are very well placed. And I think he is very conscious that there are a lot of expectations from him and his government. And I think that budget will be reform oriented. In the first year, they have no reason to be populist at all. And state elections also have been very favorable to them. So I think budget will be quite strong in terms of move on reforms and thrust on continued consolidation, whether it's a cut down on subsidies or investment in plan expenditure and infrastructure, and also the policy relaxations for taxation and ease of doing business. So I have great expectations from the budget, and I mean, wherever I have heard Mr. Jaitley as well as other ministers in public forum, I get a sense that they seem quite committed to make sure that the budget has a strong message for investors. So I would think that Jan-Feb also, I mean, there can be intermittent corrections, but I think markets undercurrent will be very strong. Also, one more thing I want to add here.
Almost everybody, sure, go ahead.
Yeah. What had happened in the last 2-3 years, that a lot of money that was coming in India was from the ETFs and emerging market funds. It's only last few months that there have been a few funds that have raised India-specific money, and they're getting very good response. So I think after the Modi government came and now things are falling in place, we are seeing that after a long time, long-only funds are able to talk about India fund and India-specific money, which is a good trend because that money is typically for a longer term, and that gives stability to the market.
Almost everybody is bullish right now, Nirmal, in the market. You would understand that after such a long and pronounced run. But what to your mind is the biggest risk which can trigger a substantial correction, more than 150-200 points on the Nifty?
No, as you rightly said, when everybody is, there's a consensus, you get worried. Because what happens in consensus is that everybody tries to leverage, and there are traders who take positions which are beyond their holding power in a normal. And so any jitter, whether it comes from the global market or something happens politically here or something happens to geopolitical or even crude oil, anything. That can trigger a sharp correction, and therefore I would say that, and that's what we are advising our clients, that market looks very good, but don't get carried away, don't leverage and hold positions. As you rightly said, that the corrections can be very sharp, so you should have the capacity to see through them. The underlying trend won't change, but when market runs up at this pace, it can always retreat and trace back some of its run very quickly, and therefore one has to be cautious. But other than that, I mean, if something unexpected happens on the global front, I mean, there is a key risk to my mind. But and if there's a disappointment in budget, that also probably is one should not rule out, because see, the government and I mean, what they do and what are the numbers at their hands. I mean, this is the first budget, full budget, I would say, from this government. So one has to see it through and just see how things roll out after that.
As you were pointing out earlier, Nirmal, on the fixed income front, debt funds are standing tall because of the way we've seen bond yields fall. Are you getting a sense that debt funds or the fixed income market could perhaps give a better opportunity to make returns in the next, say, 3 to 6 months versus equities?
So, if you look at debt funds, then I think even if the yield correct by, say, 50 to 75 basis points, and on a long-dated fund, you can make about 4 to 5% in a year in terms of capital gains. And coupled with interest, the best case scenario is they may give you 13, 14% or at best 15%. So they are good investment. When you do your asset allocation, it's very rare. It's not often that you have equity as well as debt that have a promise of above average or more than trend line return. And so debt funds are looking good. But I think there are two sets of investors are different. So those who invest in equity, they look at different kind of returns. So even if market gives you 15-20% return, equity investors will look at 30-40% or more. And debt fund investors may get more return in this year because yield can further go down by 50 to 75 basis points. But so there are different sets of investors. But yes, both the asset classes are looking good at this point in time.
All right, we'll pursue this discussion after a short break. Nirmal, just stay on with us. On the other side of the break, we'll also get Gautam Chhaochharia of UBS into our discussion. Stay tuned.